Hello traders and welcome to another trading strategy video. In today's video we will be talking about supply and demand. And we're going to use two different ways to analyze supply and demand so that we can find profitable trading opportunities in the market. So to start off with, what is supply and demand and how does it factor into the market? Supply and demand drives all markets from auctions, flea markets, all the way up to international currency markets. The reason this is because when many want to buy an item, any item that is, with limited quantity, which almost all items do have limited quantity, the price will go up until buyer interest matches the items available. So basically what that means is that buyer interest is going to, or we can also call it demand for the asset, is going to continue to rise as price rises until the point where no buyer wants to pay a higher price. And when we get to that point where no buyer wants to pay a higher price, that would be the end of the uptrend, and that would also be called the overbought zone, as many buyers come at the last minute and then you get to a point where no one else wants to buy. And the same can be said about oversold, when many sell an asset and it goes all the way down, and then when we get seller interest to equal the limited quantity, then we get an oversold condition. Also, what we can see here is this is an accumulation, this is a distribution area. And how does that factor in supply and demand? Well, accumulation is a trading period, usually almost always consolidation, where we get many buyers who are accumulating the asset. And what that means is that more buyers are entering the market than sellers are exiting. And what you're going to see when that does happen is very high bullish volume and not as high bearish volume. And then when we get to overbought, before the market goes into a markdown, or it goes down, that's another word for markdown, you're going to see many sellers who are much stronger than the buyers. And that means that the sellers have more momentum. So in a shorter period of time, the sellers move price more than the buyers do in that same period of time. So you'll see bearish engulfing candles and strong bearish momentum, and you'll also see strong bearish volume. So that is really how you can identify accumulation distribution areas. So we want to find areas where price is oversold and price is overbought so that we can find great opportunities to use supply and demand outpacing supply and supply outpacing demand to make money in the market. So how do we do that? Well, the first way that we can do that is using the money flow index, which is also known as MFI. I have an MFI 14 set up right here on CryptoWatch. It is right down here. And for those who don't know what MFI is, it is simply a volume-weighted RSI. So it looks at the volume and the momentum or strength of candlesticks within the period, this being 14. And then it does a calculation that tells me how overbought or oversold the asset is based on the market's movement multiplied by its volume. So we can see that whenever MFI goes white up here above 80, that would be oversold. And whenever MFI goes white below 20, that would be oversold. And then this would be overbought, pardon me. Any white above 80 is overbought. Any white below 20 is oversold. So if we look here, we can see that MFI was oversold on Bitcoin in this day. And we also could see that this would be a period of accumulation as many buyers piled in as price was oversold, and this would be a very, very good spot to buy. And then just going forward a bit, we can see that price was accumulating more than it was distributing, meaning that the buyers were stronger than the sellers. If we look here on this daily, we can see that, sorry, I'm holding a sneeze. we can see here that volume for this day was quite bad, as when the market did go down, it did not go down with much volume. Same here. Market barely goes down on not so good volume. And then we can see that very good bullish volume continues to enter the market. And this bullish volume means that demand is continuing to outpace supply until we get to the point where no more buyers want to buy the asset, and then the price must go down. And we reached that right here. The market did go a bit higher, but more importantly, MFI was very overbought. This means that many traders have bought the asset, and when all traders are on one side, that's when the price has to go the other way. Because if everyone's bought something, Price can't go up because the price needs fresh new buyers to cause the price to go up. So we got a point here that price was very overbought, and now price is likely to go downward as a result of that. So that is just more textbook supply and demand, where we have Wyckoff's price cycle, just classic theory using oversold and overbought and looking at accumulation and distribution. With this strategy, just the only things that you really need to keep in mind are three things. Look at MFI, and then most importantly, look at volume. Are you seeing a lot of bullish volume at an oversold point? Then that could be a good buying opportunity. Are you seeing a lot of bearish volume at a overbought point? And that can be a very good selling opportunity. And finally, momentum. Are you seeing very solid momentum, bullish momentum at an oversold point where price could be accumulating, like right here, and we have some bearish, bullish engulfing and some great continuations as well. Are you seeing more bullish momentum than bearish momentum? Price will probably go upward. And then here we can see, are you seeing more bearish momentum than bullish momentum? Then price will likely go downward. So again, that's just textbook supply and demand using Wyckoff's price cycle. My second part of this video is going to be the other way that you can use supply and demand for profitable trading. This method I like this method a bit more. It is a little bit more complicated and also slightly controversial. The only controversial point is that this theory dictates that, and I do believe this as well, the more touches that a supply the more touches that a support or resistance point has been touched, the weaker that point is. So if you see price touching a resistance point many times, typical textbook trading and investing says, oh, that point's going to be a very good spot of resistance, as you can see through past evidence. But in reality, what's actually happening is that point is actually weakening every single time the market goes up to touch it. The simple reason this is because many orders that have been put at those levels are going to be taken. And for example, if we have many sell orders at a resistance level, that's causing the market to go down. The market continues to go up, hits those sell orders, and then when those sell orders stop being hit and all the sell orders have been hit, price is going to go right through it. More touches that a resistance point has, more likely that market goes through it. And the same with support point. If many traders have buy orders, like at a point, and then support keeps getting hit until the point where no more buy orders, and then price is going to go through it. So that is slightly controversial and contrary to a lot of classical investing and trading, but I really do believe it. And you can look on past charts and look at support and resistance points and try to gauge what's strong support and what's weak support. And typically what you'll see is many touches. Usually, eventually, there will be a breakout. So what we have here is called supply and demand zones. And this is what they look like. I have highlighted 2 demand zones and 2 supply zones. So what are these zones and how can I use them to become trading profitably and know the market a lot better? Well, a demand zone is just a zone that tells me where there are more orders to be filled. And a supply zone is just telling me where there are more orders to be filled as well. This would be sell orders. So this would tell me that there are many sell orders when this price gets reached again. And this would tell me that there are many buy orders around these levels, and that if price hits that, it's probably going to rebound very quickly. This is contrasting with what I just said, that more touches that a support or resistance point has, the weaker it is. That is true, but on the first touch of one of these supply or demand zones, typically you're going to see price go in the other direction. So what are classical just examples? What should you be looking out for supply and demand zones? Well, the first thing that you want to look out for when you see a potential supply zone is that you want to see many candles to the upside. So in this supply zone, we can see many high candles here. Candlesticks here, many wicks that created tails. And also in a demand zone, you want to see the opposite. You want to see many tails to the downside, showing rejection at that level. And you can see many tails here. The second thing that you would need to see is exactly what this just said. Not a lot of time spent at that zone. So why do you not want a lot of time spent at a supply or demand zone? What does that exactly mean? All that this means in theory is, again, what I said about buyer orders and seller orders. When many traders put buy orders at these levels, we want to see not many of them be filled. Because if we see a long period of accumulation or distribution, typically that period is not going to be hit again. Typically that's going to create an uptrend or a downtrend. But when we see just a quick period of this accumulation and distribution, these supply zones and demand zones, like right here, just a few hours and then it went up. What this means is that not every buyer got his order or her order filled. This means that there's a lot of untapped orders at these levels. And a smart trader and a smart investor is going to look at these levels, and he's going to see that these levels, if they're touched again, are going to hit a lot of those orders that many traders did not get filled at. And that is exactly why the market's going to hit that level and immediately rebound. So that is also what you want to see. Not a lot of time spent at the initial supply zone, as you can see here, and the initial demand zone. Now, you also want to note that you want to see low volume at these supply and demand zones. So at this demand zone, we want to see not many traders picking up positions. Why? Well, if many traders are picking up positions at these levels, typically that means that all the orders might have been filled at these levels, all the buy orders, and that the market probably can't come back down to these levels because buyer interest is already so active here. But when we see that there's not a lot of volume, what that means is that there are many unfilled orders that are waiting to be filled right here and here to here, as you can see. And then the fourth rule is probably the most important rule. And if you get one thing out of supply and demand trading and analyzing where these points are, this is something that you really need to listen to. The stronger the breakout is, the stronger the demand or supply zone will be. This is pretty interesting. What this means is that when we identify a potential supply zone, like let's say right here, and then the market very quickly goes down, well, what does this mean? How can it help me? What this means is that the sellers are very strong and that there's a large imbalance between the sellers and buyers, and that the sellers push this price much lower. This also means that there might be a lot of untapped sell orders up here. Why is that? Well, the reason the market went down so quickly, probably, is because many traders who had put sell orders here that had not been hit some of them are gonna pull out their orders and immediately sell. And then other traders who really wanted to sell but couldn't sell at these levels are gonna sell very quickly, and they're gonna become falling over each other to sell the asset. You can see it right here, straight decline. But some traders do still keep their orders at these levels. Their sell orders, that is, instead of panic selling. And the same with the demand zone, just the opposite. You want to see a very strong breakout, almost vertical, which shows that demand for the asset is high, and you want to see very quick downward breakout for supply, because that would show that supply for the market is very high. So here we can see that price didn't spend a lot of time in the zone, not a lot of volume. We have low candlewicks, perfect. We're checking off all the boxes. And then we can see that there was a very strong breakout that went immediately upward right here. Again, all this means is that not many traders were able to get their buy orders filled at these levels, and that price jumped up these levels, and that traders will be falling over one another to buy the asset. And you can see that evidence right here. But again, the smarter investors and the smarter traders didn't just panic buy and overload these positions for the market to go higher. Instead, they just kept their orders at these levels. And that is exactly what we want to do as well. We want to target where the institutions are targeting as well, instead of buying where all of the retail traders are buying. So if you want to do that, then what you can see here is that this had a very strong breakout. Like I said with the other three rules, it fills those as well. And that if this zone is hit again, it will likely be absorbed by buy orders. And look what happened right here. Price goes down for a bit, hits all those buy orders that were just there on very high volume. Again, you want the first touch of that supply or demand zone to have very high volume to show that many traders are picking up the asset. You do not want high volume at the creation of the supply or demand zone. So high volume here, many traders picking up, those orders are being filled. This is where you buy. When demand for the asset is beginning to pick up with buy orders. And same here. We had supply begin to pick up for the asset right here. And then you can see that we had very high bearish volume, as many traders who had put those orders, they get hit, and then the market goes downwards with those sell orders. So that's going to be it for this video. Just one more note is that you want to see something called a fresh zone when we're talking about supply and demand zones, because we're talking about unfilled open orders. This would not be a supply zone if, for example, the market had gone up here and hit these levels already, and then let's say went a little bit higher and then hit this again. That's not a supply zone. A supply zone has to be fresh. A supply zone being fresh means that the market in these periods right here is not touching this level until you get to this level, where when the market is touching that level, then you have that example. Same here. We can see that this demand zone is a demand zone because it's not touched by any of these candles until we get to this area here. So you need to look for areas where potential supply and demand areas that have not been touched recently. Okay, so that's going to be it for this video. We've gone over two different ways. To recap, we've gone over two different ways that we can analyze supply and demand. Our first way is just using wick-off price cycle, just traditional textbook oversold, overbought areas. Then we have the more interesting, a little more unorthodox, thinking like an institutional trader way, where we're looking at supply and demand zones, which are zones that many unfilled orders might be at and that might be turning points in the market. One popular way that you can label a supply and demand zone is just to do this. For example, if you saw this to be a good supply zone, you could just do this and then mark it until it gets hit again. And then that would keep, as you're trading, you could put an alert as well when that gets hit, because that's probably going to be a supply zone. So that's one way that you can use supply and demand zones in your trading. So that's going to be it for this video. If you have any questions on what exactly a supply and demand zone is, I know it is a little bit complicated and unorthodox, and that's why I'm more than happy to answer any question or point you towards any article that could possibly answer it better than I could. So that's going to be it. Thanks for watching, and happy trading.